Every single day, over $6 trillion flows through the global foreign exchange market. To put that in perspective, more than a third of that staggering volume routes through London alone. But unlike traditional stock exchanges, you can't walk onto the trading floor of the FX market. There is no opening bell. It's a completely decentralized, over-the-counter network comprised of major international banks trading directly with one another. Because there is no central physical location, the market never really sleeps. It operates in a continuous 24-hour cycle, spanning 4 major geographic trading zones. The cycle starts in Sydney, moves to Tokyo, hands off to London, and closes out in New York. During the handoffs and overlaps, where 2 sessions are open at the exact same time, the market sees massive surges in both trading volume and liquidity. To manage this relentless, centerless flow of capital, the entire system relies on one foundational rule. A single currency has no absolute value on its own. It can only be measured by how much it's worth compared to something else. When we look at a currency pair like the euro against the US dollar, it breaks down into 2 parts. The first currency listed is the base currency, which is always equal to exactly 1 unit. The second is the quote currency, which tells us exactly how many dollars it takes to buy that single euro. To keep this market moving, major banks act as market makers. They constantly provide 2 simultaneous prices for these pairs: a bid price, which is what they will pay to buy your currency, and an ask price, which is what they will sell it to you for. The gap between those 2 numbers is the spread. In an over-the-counter market without a central exchange charging standard fees, this spread is the primary way these dealers generate profit on every single trade. When you agree to an exchange rate right now, you are executing a spot transaction. The deal is locked in immediately, even though the actual cash won't officially settle until 2 business days later, a standard known as T+2. The spot market handles the present perfectly well, but global commerce involves ordering parts today and paying for them in 3 months. If businesses cannot secure price certainty for transactions happening in the future, international trade grinds to a halt. Imagine an American company needing to pay a European supplier in 90 days. With exchange rates fluctuating every second, waiting 3 months to convert those dollars exposes the company to massive risk if the euro suddenly spikes in value. To eliminate that risk, the company can use a forward exchange contract. This is a binding agreement to buy or sell foreign currency at a specific fixed exchange rate, with the actual settlement happening on an agreed-upon future date. You might assume banks set this future rate by predicting where the economy is headed or speculating on geopolitical events. They don't. The forward rate relies on a strict mathematical law known as interest rate parity. This formula takes the current spot rate and adjusts it based entirely on the difference between the short-term interest rates of the 2 countries involved. The logic holding this equation together is that the forward exchange rate must make an investor completely indifferent to the interest rates available on bank deposits in either country. If the quote currency offers a higher interest rate, the math automatically forces the forward exchange rate higher to perfectly balance the scales. This mechanical adjustment exactly offsets the interest rate differential. It ensures that an investor cannot simply convert their money, park it in a foreign bank yielding a higher return for 90 days, and convert it back for a guaranteed extra profit. The future value of money in this market is an absolute mathematical certainty, dictated by domestic interest rates. It completely removes human guesswork, fear, and greed from the pricing equation. In daily trading, brokers quote this math as forward points, added to or subtracted from the spot rate. A currency's forward premium or discount is rigidly defined by whether its interest rate is lower or higher than its pair. This rigid parity acts as a global safeguard. By keeping currency values and interest rates locked in an inescapable mathematical relationship, it prevents arbitrage, the ability to extract risk-free profit by exploiting price differences across international banking systems. A system moving $6 trillion every day could easily spiral into chaos, but the foreign exchange market operates as a meticulously calculated, decentralized engine, quietly enabling and stabilizing the modern global economy.